90, 90, 90. The combination of those numbers is the most terrifying statistics in the whole world of finance and investing, and that concerns you. Can you imagine 90% of the retail traders lose 90% of their capital within 90 days? So how can you successfully avoid being part of these sad statistics? It starts, of course, with education. I'm not gonna tell you have to learn, you have to educate yourself. Yeah, of course. But one single factor regarding the market is overlooked and is basically leading you to the cemetery of the retail traders. When entering into an asset class, a market, a new realm of investment possibilities, one of the first things that we need to do as professional investor is understand the opportunity and the risk of said market or said asset class. Meaning that if I'm focusing on small or mid cap in the US stock market, I will think, okay, those companies are growing companies. Those companies can deliver double-digit returns. But if my investor profile cannot digest an elevated amount of risk or volatility, then I am heading for a big trouble. Because if a simple look into the statistic of those type of market, let's say the small cap market, will quickly reveal that the volatility of this universe is much higher than what I can tolerate. And this is the work that most investors are not doing. They are just looking at the potential or projecting their fantasy into that market will make me rich or that asset class will respond to my financial goals. This is wrong. You're heading for a big disappointment if you're thinking this way. For the simple reason is that you are not going to impose to the market your need, your requirement, your obligation. The market will give you a representation of what you can expect. And what do I mean by that? Looking at historical data will tell you, on average, how much return can I expect on a monthly basis? How much can I expect on a yearly basis? Or how much can I expect on a daily basis? And when I say expectation, you cannot dissociate return from risk. On a risk-adjusted return, meaning for each amount of return, what are the risks associated to it? So how much risk am I taking for how much return I expect to earn? This is what we mean by expectation. So if the market is giving me the potential, the expectation of earning 5% on a monthly basis, and for that I'm risking 5% of my capital, just to simplify things. So 5% of return for 5% of risk. It's not great. Obviously, you want to earn more than the risk that you're taking, but for the sake of illustration, let's take that example. 5% of return for 5% of risk on a monthly basis. So now if my demand are 10% per month of return of performance, then that market statistically and realistically is the wrong one for me. I should not expect making 10% of return on a market that has historically returned on a monthly basis 5%. And this is exactly why day trading, especially in Forex, is the biggest scam that one can encounter in the investment universe. And I am raising all the red flag for you, and I'm warning you against all the scams that you're going to encounter in your investment journey. Yes, it is one of the largest market, the most liquid market, trading 24 hours in a day, 5 days a week. Yes, and that those are arguments that brokers and social media gurus are giving you. Yes, you can get 10 times, 100 times, 1,000 times leverage in this market. But if you are putting the marketing aside, the sales aside, and the fantasy of living off your trading aside, and you're actually looking at the number, you will realize that when accounting for transaction cost, commission cost, leverage cost, day trading in Forex is probably one of the least profitable activity in the whole investment scheme. even crypto, statistically, it's better off. Although you will naturally think, oh, crypto is extremely volatile and it is extremely risky, and you can basically, with the rug pull and all of this nonsense, you can basically lose everything from 1 hour to the next. Yeah, that's true. But the return also extravagant. You can basically multiply your capital by 2, by 3, by 4 in a span of few hours, few weeks, or few months. You will never be able to multiply by 2 or 3 your capital of Forex over a short time horizon. Whether a day, whether a week, a month, a few months, you will never be able to do that, right? Statistically speaking. So you are being targeted and sold an illusion. And a simple look into the data of the market will reveal you the reality of that market. And that should be applicable to all markets you need to venture into, all of the market. And this is the secret of successful investment. The secret is looking into the statistics, and which is basically the identification of the market. If I'm investing on a weekly basis, historically speaking, in that market, how much return can I expect? How much risk am I taking? Am I comfortable with that? Does it meet my return or risk parameters, objectives and requirements and tolerance? Yes, no? If it's not the case, then let me increase the time frame. Maybe the same market, but not on a weekly basis, but on a quarterly basis, will have more favorable parameter when it comes to my personal preferences. Maybe. But if on a daily, weekly, monthly, quarterly, yearly basis, it still doesn't make sense, then let's forget about this market. And no amount of leverage, no amount of investment or trading strategy, no amount of planning and economic theory will compensate for the fact that this market is intrinsically not the right one for you.